catching high probability reversals before the market explodes in the opposite direction is possible. But most traders miss them because they misread liquidity and trust false breakouts. Look at this chart. Notice how price runs below a previous low, traps sellers, and then suddenly rallies with strong momentum. Most traders think that move is random. It is not. The real truth is the market is deliberately engineering stop runs to create new price delivery. So the question is simple: are you recognizing these traps or trading directly into them? By the end of this video, you will understand the breaker framework and how it reveals precise institutional reversals. Let's get started. We are going to study the breaker. Specifically, we are looking at how this type of mitigation can be used to identify a trade setup. We begin with the assumption that we are observing price action as it moves lower and forms a short-term low. Eventually, when that short-term low is violated and price trades downward into a support level, we interpret that initial move below the previous low as a possible false break. This is often referred to as a turtle soup long below short-term lows. Below those short-term lows there will be sell stops resting. Our expectation is to watch and see if the market intends to move back above that short-term low. Initially, price may rise and interact with that same old low. It may appear to treat it as a resistance level. However, we prefer to wait and observe whether the market will produce a significant move higher. Eventually, when that occurs, it will appear in the form of a market structure shift. Price will take out the high, or the short-term high. That high becomes the level we focus on. Then we wait for price to return back down into that old high. When price trades into that level, we view it as genuine support. This is because there will be orders inside that high that need to be mitigated. In other words, traders that were short at that high will want to close those short positions. Many of them will also look to align with the new upward move in price. As price moves away from that level, it confirms the breaker. After that confirmation, we begin looking for higher objectives in price action. Again, the focus is on the high that sits between the two lower lows. One of those lows must be traded below. That move will run into the sell stops. We place our attention on the short-term high located between those two lows. We treat that level as resistance that has been broken. Once broken, it becomes support. That is what forms a bullish breaker. Conversely, we can analyze the market from the opposite perspective. If the market trades higher and takes out an old high, and then later breaks below the low that created that new high, our focus moves to that level. That situation forms a bearish breaker. Now let's examine a closer look at a bearish breaker. A bearish breaker is defined as a bearish range or down closed candle located in the most recent swing low prior to an old high being violated. The buyers who purchased at that swing low and later see that same swing low violated will want to mitigate their losses when price returns back to that swing low. Because of this behavior, it becomes a bearish trade setup worth considering. In this example, we have an old high here that price trades through and rejects. The move runs the stops resting above that old high. Those buy stops become neutralized. After that occurs, we focus our attention on the swing low that formed between the two highs. We then observe a market structure break and price retraces back toward that swing low. That level forms the bearish breaker. From there we anticipate the formation of another low as a new leg of price moves downward. The key elements we are looking for include an old high being taken out, or a false break above that old high. This run-on by stops indicates that buyers have been trapped long. We know this is true when the market performs a rapid repricing move. This is visible here as price quickly reprices lower after the buy stops are taken. That movement confirms that a breaker is potentially forming. The low is then violated here. Once market structure breaks downward, any future retracements are treated as new selling opportunities. This becomes especially relevant when price trades back upward into this low here. That point provides our bearish breaker. Now let's discuss a bullish breaker. A bullish breaker is a bullish range or an up-closed candle located in the most recent swing high prior to an old low being violated. The sellers who sold at that low and later observed that swing high being violated will want to mitigate their losses when price returns to that swing high. This creates a bullish trade setup worth evaluating. Again, we begin with an old low being violated. This action runs the sell stops resting beneath that old low. Our swing high becomes the level we monitor for the bullish breaker. However, We must wait for price to break above that swing high. This confirms that a run on stops has occurred. Inside that old swing high there will reside the bullish breaker. When price retraces back down to that swing high, that is where we would consider buying. The expectation is that mitigation will occur there. The sell orders that push price below the old low will now be underwater or unprofitable. Because of that, those traders will want to close their shorts. At the same time, they may begin building new long positions. That behavior forms our bullish breaker. Afterward, we expect to see price expand upward into a new range. There are several clear signs that indicate a breaker forming or being confirmed. First, the run on sell stop signals that sellers are trapped below the old low. Next, we see a range expansion that breaks the short-term high located between the two lows. Then the repricing higher that follows the sell stop run confirms the event. This movement indicates the market has indeed run stops beneath an old low. Once the old high is violated, it supports a market structure shift toward bullish conditions. This upward move confirms that the structure has broken higher. From that point forward, any retracement is viewed as a new buying opportunity. When price trades back into the old swing high here, we identify that as a bullish breaker. Now let's look at an example in real price action. Here we have an old low. The market trades below that low and pushes through it again. After that, price rallies upward. What we are observing is a market structure shift following the removal of sell-side stops. This produces a large repricing movement. After such a move, the market often seeks to retrace lower. So we ask the question, where is our focus level? We locate the short-term high and the final up-closed candle position between the two lows that recently formed and triggered the sell stops. That can be seen here. At this point, the structure can be interpreted as a bullish breaker. Our expectation is for the market to continue trading higher. When price retraces back into that level, the previous selling orders are mitigated. New buying orders replace them. The price action that follows is exactly the type of movement we anticipate seeing in our charts. Spend time studying your charts. Look for examples where the market forms a low and then trades lower once more. Then observe when price rallies through the short-term high between those two lows. This is where traditional support concepts often appear effective. Many traders have experienced this early in their trading journey. We draw horizontal lines and believe support and resistance alone will explain everything. But price requires a narrative. There must be a logical explanation behind what the market is doing. When you understand what the breaker represents, you realize it is signaling a run on a pool of liquidity. When a short-term low is violated, locate the short-term high that formed most recently. When price retraces back to that level, it often becomes a highly probable support area for bullish movement. You can see that behavior here. Price is trading inside the range created by this final up-closed candle. We therefore use the entire range. Price trades back down into it and recapitalizes the selling activity. Those who sold here to drive price down and trigger the sell stops are now underwater. They are losing money at this level, but they typically have deeper pockets than we do. They will wait for price to return to a level where they can mitigate those short positions and begin accumulating longs. That is exactly why we observe the explosive price movement that follows here. Hopefully this discussion has provided additional insight into breakers. We will continue expanding on these concepts as we progresses in the coming months. That's it, traders. Thank you for watching. I hope this explanation delivered greater clarity and practical insight that you can apply to your own trading. Make sure to subscribe and turn on notifications so you never miss future content. Leave your questions and suggestions in the comments section below. And let us know which topics you would like to see covered next. We truly appreciate your support, and we look forward to seeing you in the next episode.